You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Wednesday. So today, the sun is finally coming back. It's been a while. We had like a terrible month of May. So because I'm feeling happy, we're going to talk about the best performing stocks, Canadian stocks in my portfolio year to date. It's a fun exercise to do. Nothing fancy. Year to date, like almost 6 months in, not much to get out of that in terms of like, oh, those are great returns or those are bad returns. I mean, it's only for a few months, guys. But what is interesting is to see the dynamic of the market and understand a little bit more why those companies are doing well or not at this specific stage. So we're gonna start with the number, like the number 5 on that list, up 24%, and those are total returns. So including the dividend, the stock price appreciation starting January 1st and ending on the morning of May the 26th. So first one on my list, Stantec, STN. This one, I'm super happy to have it. I've been talking about Stantec for a while for a lot of reasons. Actually, right now, the reason why the stock is up 24% and doing a lot better than the rest of the Canadian market is definitely because of the results. There is a very strong narrative around investment in infrastructure and the need for engineering firms to support for those massive investment, but also for the kind of like the greening process. So investing into a lot of like optimized, structured, green, eco-friendly structure as well, and all of that. And Stantec is doing all of this. Actually, it's a complete engineering firm going from like planning, constructing, maintaining, and also getting rid of any infrastructure. So Stantec is doing well, and it's gonna keep on increasing its dividend going forward. The reason why I have Stantec and not WES Global is that is exactly this. I focus on my strategy that is around dividend growers, and unfortunately WSP Global doesn't increase its dividend, but both of them shows very strong metrics. So this one is a full position, which is great. The next one, actually, I recently started investing in this one. It has been on my radar for a while, but did not have much money laying around. So I don't have much money invested in it. TMX Group, ticker is X.TO, up 26%. And this one is kind of like, it's amazing. It evolves kind of like in the almost monopoly, because if you want to trade, if you want to issue shares like new IPOs on the Toronto Stock Exchange, well, you have to go through TMX. And the best part is, and all like financial places like this for like stock exchange are doing the same thing. They are making a lot of money with this, but they're also making money by selling their data analytics. And I know for a fact, because I'm paying big bucks to get all that kind of information, and all stock exchange are selling those. So recurring revenues for them, plus every time that there's a transaction somewhere, the TMX is making a cut. So definitely a great place to be. There is competition, of course, and actually I think the Canadian market is being eyed by other like players. But so far, so good. The company is doing well. Amazing dividend triangle, great returns. And as long as there are volumes and volatility, a company like TMX will continue to do well. So I wish I had more on this one. On the number 3, an interesting play, actually more speculative, and that is part of my Smith maneuver. So again, a very small portion. It's kind of bad, like, because those stocks would have been great in a large position. But anyways, on this one, actually, the past 3 years have been terrible. So it's not the end of the world if I have like just a few dollars invested. But it's Nutrien. Nutrien, including the dividend, NTR is up 29% year to date. Kind of crazy, but I mean, it's negative over the past 3 years. So don't get too excited there. Nutrien is a classic commodity play. What that means is the key is to buy it when it's low, and then when it's gonna go on a big ride after a while, when like fertilizer prices such as potash goes up, well then boom, you could sell Nutrien, making a very solid profit. In the meantime, you have to swallow this roller coaster ride. The stock has not gone anywhere since the end of 23. Actually, it was trading around $80 back then. It's still back to $80. It had like a kind of weekend in purgatory at around like $60-65. Now it's getting a little bit better, but it's all about the same story over and over again. If potash prices and other fertilizer prices go down because of demand, because of oversupply, well, Nutrien stock price is going to drop. And then when everybody wants more, well, stock price is going to go up. So that's what's happening right now. Slightly recovering. Nothing fancy here. Don't get too excited. Definitely a volatile play, but up 29%. So cannot say it's a bad one this year. Number 2 on my list, almost the best performer stock in my portfolio. Again, a small position in my Smith Manaver account, in my new account on YouTube that I invest $1,000 per month. So a very small position, but I thought it was a good timing to get into it, mostly because of tariffs, because of uncertainties and volatilities. Well, I made a small play on gold. I know, not a big fan of that actually, but it was a good timing and it's actually paying off. So Franco Nevada, FNV, up 37%. That's kind of crazy. I saw the opportunity though, because even though I'm not a big fan of investing in like gold mining stocks or the yellow metal, what I find interesting about Franco Nevada is that it doesn't have any debt and it has like great assets, great lands, and what they do is they get a commission, like not a commission, but a royalty on whatever is being extracted. So they're making money while they're leaving all the exploration risk, the mining risk to the operator, and they're just collecting their royalty. So I love the business model. It's up 37% because gold price is going up. So it's a bet on fear. I was really aware of that. And I don't expect this one to be a large portion of my portfolio anytime soon. Fun experiment. It's fun to do that from time to time. It's interesting to have like smaller position in your portfolio, especially when you're doing like leverage and stuff. You want to make like plays that could be interesting. So Franco Nevada is part of that. Very stable type of business as opposed to investing purely in the commodity. So now you're probably wondering, what is my number one? My number one is up 45%. And this is actually a full position. So I was like very happy to add it to my portfolio in my RSP a little bit more than a year ago. And it doesn't seem to stop. It's a small cap. Well, now reached like 3 billion in market cap, but I mean the stock price tripled since the beginning of 2024. So that's why I'm saying it's still a small cap. Very low yield now. Young dividend grower, about 3 years now, consecutive dividend growth. So not much here. It was not on my radar before that for obvious reasons, because it did not have like a strong dividend triangle before that. So in 22, that was the first increase. So 22 to 23, 24, 25. So 3 increases. That was great. But then the revenues and the earnings are growing about the same pace. So that's just perfect, right? It's just like the perfect type of dividend triangle. Over the past 3 years, you have like double revenue, up 82% for earnings, and up 75% for the dividends. So, and that magnificent company, I mean, I'm exaggerating, but here, Terravest Industries. So they are growing fast because they're making a lot of acquisitions. They're taking care and they're selling like natural gas tanks and other vessels for that. And what they do is they also charge maintenance fees. So once they are installed, what is great is they actually able to generate some high margin recurring fees on that too. The company definitely volatile. Be careful with that kind of stock. I'm not telling you to buy it. It's kind of like a rocky road one, but it's so far I'm enjoying the ride, definitely. So hopefully they're going to be able to continue to grow by acquisition for a while. I mean, there's a small cap, so there's plenty of space to grow. So that's going to be interesting. I wanted to end this episode actually on a special mention to TELUS. TELUS is up like 16%, including the dividend. It's not as good as my top 5, but I was just like, oh, finally, there's some kind of like life getting back into that corpse of telco. Definitely the last quarter was good. It used to be in my top 10 largest holdings. It's not anymore because the rest of my portfolio performed a lot better. But I was kind of happy to see that there is a dividend growth policy in place now through 2028. The cash flow metrics are still going better, and the market has rewarded the stock. Now it's trading around $22. The yield's at 7.5%, so we're not out of the woods yet, but just wanted to mention, sometimes, you have like stocks that are not doing well for a while, and eventually they could come back. I mean, we all wish it's the case for all of those, and we all know it's not going to happen. Speaking of which, tomorrow we're going to talk about my worst performing Canadian stocks in my portfolio. So do not miss that episode. A lot of good content to talk about those. And we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.